Welcome to another edition of Brian Montross Talks Real Estate. Do you want to invest in real estate, but you're not sure how to pay for it? Financing can make or break your first rental property deal, and choosing the right loan is just as important as finding the right property. The right financing strategy can help you maximize returns, minimize your risk, and scale your portfolio faster. Today, we're breaking down the top financing options for real estate investors, covering everything from traditional loans to creative funding strategies so you can choose the best path for your investment goals. So let's get started. Number 1, conventional bank loans. A conventional loan follows Fannie Mae or Freddie Mac guidelines. Approval depends on your credit score, your income, and your assets. And lenders typically require at least 6 months of cash reserves. Future rental income usually isn't factored into your debt to income ratio either, making it tougher for new investors to qualify. And if you don't get income from a W-2 job, it's even more difficult. Conventional loans typically require a 20 to 30% down payment. But if you plan to live in the property while renting out a unit or a room, a strategy known as house hacking, you may qualify for a lower down payment, as little as 3 to 5% with an owner-occupied loan. This is a great way to get started in real estate investing with lower amounts of capital. Additionally, investors should be aware that there are limits on the number of conventional loans one can hold. The number does change, but right now I think it's around 10 finance properties per borrower. Some pros: lower interest rates, longer repayment terms, and easier access for those with strong credit. And cons: strict qualification requirements, large down payments for non-owner occupied properties, and a limited number of allowable loans. Number 2, DSCR loans, or debt to service coverage ratio loans. A DSCR loan is specifically designed for real estate investors because it focuses on property's income potential rather than the buyer's personal income. So instead of requiring W-2s or tax returns, lenders assess whether the rental income from the property covers the mortgage and the expenses. This makes it an excellent option for investors who may not meet the strict income verification requirements of a conventional loan. Some pros: easier qualifications for full-time investors, no income verification, and can be used for multiple rental properties. And cons: interest rates are typically higher than conventional loans, and lenders often require a higher down payment. 3, hard money loans. A hard money loan is a short-term financing option best suited for flipping properties rather than for long-term rentals. It's funded by private lenders, and it's based on the after repair value of the home rather than the borrower's creditworthiness. These loans offer quick approval, often within days, making them ideal for time-sensitive deals. However, they do come at a cost. Interest rates can reach 10 to 18% or even higher, with short repayment terms, often under a year, and high upfront costs. While easier to qualify for than conventional loans, their high costs can eat into profits, making them best for experienced investors with a clear exit strategy. Some pros: fast approval, no strict income verification, and suitable for short-term projects. And cons: high interest rates, short repayment periods, and significant fees. Number 4, private money loans. A private money loan is financing from individuals, often friends, family, or local investors. Terms and interest rates vary widely, from favorable to even predatory, depending on the lender. These loans are usually secured by a legal contract, allowing foreclosures if payments are missed. But you may be able to get an unsecured private money loan that you can use on any project. Some pros: easier approval, faster funding, even with poor credit. And cons: Higher interest rates, fewer protections, and potential risks to personal relationships if the loan goes unpaid. Careful consideration is crucial before borrowing from friends or family to avoid financial and personal strain. Number 5, seller financing. Seller financing allows buyers to purchase a property directly from the seller without traditional bank loans. Instead of securing financing through a lender, the buyer makes payments directly to the seller over time, typically with an agreed upon interest rate and repayment schedule. This option is ideal when a seller owns the property outright and is willing to act as the lender. Some pros: lower closing costs, flexible terms, and easier qualification compared to conventional loans. And cons: interest rates may be higher than traditional loans, and sellers may require a larger down payment. The buyer must ensure proper legal documentation to protect both parties as well. Number 6, home equity. Using home equity to finance an investment property can be done through a home equity loan, a HELOC, a home equity line of credit, or a cash out refinance, typically allowing you to borrow up to 80% of your home's equity. A cash out refinance offers a fixed rate, but it extends your mortgage term, potentially increasing long-term interest costs. A HELOC works like a credit card with a variable interest rate, providing flexibility but requiring discipline to manage payments. I would really look at a HELOC as a short-term loan rather than a source for a down payment on a long-term hold. Some pros: access to substantial funds with lower interest rates than most investment loans. And cons: your primary home is at risk if you default. Borrowing limits depend on available equity, and HELOC rates can fluctuate, affecting your monthly payments. Careful planning is essential to avoid financial strain. Number 7, commercial loans. Commercial loans finance multi-unit commercial and mixed-use properties, offering higher borrowing limits and longer repayment terms. However, they typically require larger payments as well and extensive documentation. These loans often have shorter terms, 5 to maybe 20 years, with potential balloon payments, meaning investors may need to refinance or pay off the loan in a lump sum. While commercial loans offer competitive rates, they come with higher fees and a lengthy approval process, making them best for experienced investors with strong financials. Some pros: higher borrowing limits, competitive rates for strong borrowers, and financing for large investments. And cons: large down payment requirements, complex approval process, and potential balloon payments, and even early payment penalties. Number 8, all cash purchases. Buying a rental property with all cash eliminates the need for financing and mortgage payments, allowing investors to own the property outright from day one. This can be a great way to secure properties quickly, avoid long-term interest costs, and benefit from higher cash flow. Some pros: no mortgage payments, faster closing process, increased negotiating power, and higher cash flow. And cons: ties up a lot of capital that you may not even have. It's limiting your liquidity for other investments down the road as well. So there you have it. Securing financing shouldn't be a barrier if you explore the right options, whether you're leveraging loans or you're buying with all cash. Consider both short and long-term costs to protect your investment's profitability. Real estate comes with market shifts and management challenges, but staying informed, strategic, and risk-aware can position you for success. Research thoroughly, seek expert advice, and invest within your means. I'd love to hear your thoughts. What's your biggest challenge when it comes to financing an investment property? Drop your comment below. If you found this video helpful, don't forget to like, comment, and subscribe for more tips and advice on all things real estate. Thank you for watching. And once again, I'll leave you with this verse. Be strong and courageous. Do not be afraid. Do not be discouraged, for the Lord your God will be with you wherever you go. This is Brian Montross, your real estate advisor.